Welcome back to Retire ATL. It's all powered by the Vincent Financial Group. 770-741-0120. Again, 770-741-0120. That's how you reach out to the team of the Vincent Financial Group and schedule that no-cost, no-obligation consultation. There's nothing wrong with asking the questions. It's your life's work. It's your money. That second opinion, all it's going to cost you is the time it takes to make the phone call. 770-741-0120. Always available at retireatlradio.com. Matt, you did it, buddy. You got angry, agitated Aaron in the house today.
I had to. He's been on vacation for so long. You can't have him come back feeling all great, running with the bulls. No, we got to get him fired up.
We've learned his hot button issue, taxes.
I feel like one of those bulls seeing red, taxes.
Talking about taxes this weekend here and your tax strategy. So, Matt, let me ask you that. Like, how can you help? Who are we talking to? Who can we help with their taxes?
Yeah, I think what we really want to make sure of is that the cure is not worse than the disease, right? So having a tax strategy in place, it's only going to apply to a certain subset of the population. So we're talking people who are high income earners, who are going to be the focus of the government when they need revenue. When the government needs revenue, they're not going to go to the person who's only living on Social Security for more revenue because there is no revenue there. So we're talking about high income earners. And if you talk about the largest sum of untaxed money in the United States, the largest sum of untaxed money in the United States is sitting in retirement accounts, which is why earlier we're talking about RMDs, and it's why now we're talking about tax strategy. But hear me on this. You have to have a certain mindset about taxes in order to see this through to the end. And the mindset really needs to be, because look, there's no just way out. You have to come to the realization that you've made a handshake deal with the U.S. government. If you've got if you got $1 million, $2 million in qualified accounts, 401k, SEP, Simple, 403b, TSP, if you got $1 million or more, you've made a handshake deal with the government. You've said, you're not going to tax me on this money right now, but you can tax me on this money later when I take it out at whatever rate the tax rate environment is when I take it out. So what rate's that going to be? You don't know. Okay, you don't know. You've made that handshake deal. So Aaron, great guy. He goes on mission trips. You know, he's philanthropic,
good husband,
good father,
helps the community.
There's a butt coming.
Here's the deal. Here's the deal.
Don't say but. However,
I know the real Aaron, and I know that Aaron's been in trouble before.
I've gotten in trouble a few times. Yeah.
And so I would love, Aaron's got a great story about the type of mindset that it takes to solve the tax problem. And I thought you should tell the people.
I know exactly where you're going with this. And if I'm wrong, correct me. Okay. But when I was a kid, it may be hard to believe, every now and then I would get in some trouble. And my parents are good parents, and I had a consequence every time, if they knew about it, that is. And when I was really young, they had no problem with spanking, by the way. My parents had no problem with spanking, and I'm thankful for it. But when I was really young, it was a spanking. That's what I got. But then as I got a little bit older, I don't know, maybe 9, 10, 11, they began to give me options. They could say, hey, whatever I just did. Let's say I threw a rock and broke a window. I don't know. And they could say, hey, listen, you're either going to get a spanking or you can choose to be grounded for a week. Which one do you choose? You're going to get a consequence. You can choose which one. And I remember the first time this happened, I was kind of like just struck. Like, wow, number one, I have an option. Didn't even know that was going to come. Number two, which one do I choose? One of them comes with immediate and severe pain.
Right.
The other one comes with this prolonged like torture of seeing my kids, my friends play outside, playing sports, summertime, and I got to watch from inside in the window. Mind you, we didn't have phones and Wi-Fi back then. I'm just tortured by that. So I got to choose. Well, the first few times I probably did choose getting grounded because it just didn't have the pain, but it didn't take me long to realize like, no, spanking's a better deal. I mean, it hurts and it's not pleasant for a short period of time, but then you're done. And so, Matt, if I know where you're going, this is the story you're talking about. So I think that story applies in this way. Look, if you've got a big sum of money in a qualified account, IRA, 401k, et cetera, there's no magic pill. I don't care what attorney you have. I don't care what accountant you have. There's no way to not pay tax on that. You're going to pay tax on it. But how you pay tax on it and how much it actually costs you is up to you. What do I mean? You can choose to get spanking, or you can choose to get grounded.
If you're pre-73,
yes.
If you're not
taking
RMDs, you don't have to choose the grounding.
You got an option.
That's why I said, and the compliance people don't like it, but it's true. That's why I said it's optional.
Yep.
It's Aaron as a 16-year, you probably weren't 16 getting spanked.
26 still getting spanked.
It's Aaron as a, 10-year-old boy, rock through the window. Do you want the spanking or the grounding? If you're pre-RMD age, you can actually choose.
Take the hit now.
And a lot of our clients, they see how much national debt we have. They see that every political figure running for office knows how to spend money, all of them.
Right.
And a lot of them understand the math problem that we talked about earlier. It's a math problem. We can't spend less enough, which means tax more. So if you're a high income earner, where is the government going to get their tax revenue from? From you. And so do you want to be grounded forever, or do you just want to take the spanking?
But I totally get what you're saying. But the bigger question is, though, Aaron, did you even learn your lesson? Because you've done a great job negotiating. Do I want to get spanked or grounded? But did you learn your lesson? Don't throw the rock through the window?
I did. Yes.
Yeah.
Life is better if you don't throw rocks through windows. Let me tell you that. But to Matt's point, I want to make sure this is crystal clear. You have an option, right? And it doesn't have to be, if you see the government's got two levers to pull, and as Matt just described, one of them is not an option, actually. The only other one is raise taxes. If you even think it's a high likelihood that tax rates are going to go up in the future, or if it's a high likelihood that you think the government's going to come up with more ways to do things like RMDs or more secure acts, if you think those things are likely in the future, then you have options to get that money over the fence now. That's the spanking. Yes, it does hurt. You got to pay Uncle Sam this year. You got to convert that money from IRA to, say, Roth IRA and pay the taxes today at today's tax rates. That's true. It's a spanking. It still hurts. But it's better than, in my opinion, it's better than waiting and not doing it because you're afraid of that current short-term pain and waiting and doing it later, to Matt's point, at some handshake deal, whatever rate the government chooses. And oh, by the way, over 10, 15, 20, 30 years, I can promise you that tax bill is going to be a lot more than if you do it now. So that's not a prescription. I'm not saying everyone should convert their entire IRA right now today. What I'm saying, though, is our main point here is you have options. It's not just this issue, this major problem, and you have your hands are tied behind your back. You have no decisions to make. You actually have options, and we love solving these problems.
And you said, I can promise you your tax bill is going to be higher. We probably can't promise you that your tax bill is going to be higher. But
well, let me clarify, because I want to make sure I know where
you're
going
to get in trouble. I got in trouble last time. Now you're in trouble.
I'll take the spank. But if tax rates go up and you choose to defer till later, your tax bill will be higher. Now,
if you're
point,
a high-income earner
correct.
with lots of dollars in qualified accounts, look, if you've got no money in qualified accounts, you don't have to worry about this.
Yeah.
If you've got no money saved up for retirement, you don't have to worry about this. If you're going to only live off of Social Security as your sole source of income, you don't have to worry about it.
Or if you somehow believe that tax rates are going to go down in the future.
I want to meet that person.
Don't worry about it.
That's somebody who's never been spanked.
Good luck.
That person who thinks that taxes are going to go down, it's okay. You'll be fine.
We don't have any of those clients.
None. 770-741-0120. That is such a great analogy. Take the pain right now because we've got to pay taxes. You're going to have to pay taxes.
The numbers are out there.
Take the pain now, or do you want to, spread it out and make it last longer? No. 770-741-0120. These are the conversations that you'll have with Aaron Vincent, Matthew Decker, and the team of the Vincent Financial Group when they create and customize a retirement plan for you, but most of all, focusing on that tax strategy. You can always get more information when you visit retireatlradio.com. All right, is there a such thing as tax-free money out there?
There certainly is, and let's talk about that. But can I back up just 1 second?
Of course.
Because we already talked about Secure Act and how shady way to increase taxes without actually increasing the tax brackets. And we've talked about RMDs being optional if you're, under the age of needing to take them, probably 73 for most listeners. Well, let's talk about one other thing, because when does everybody file for Medicare? What age?
65. 65.
Right?
That's right.
What am RMDs are 73.
That's right.
RMDs are 73. At 65, pretty much everyone's going to sign on for Medicare. And how do you pay for Medicare? For most people, they're actually going to pay for Medicare directly out of their Social Security check. A lot of people don't know that unless they're already taking Social Security and Medicare, but that is how Medicare is going to get paid. Okay. Well, if you're under the age of 65, now, listen, we're really talking to you, because not only do you have an opportunity to avoid RMDs, starting at 73 for most people, you also can set yourself up to avoid surcharges on your Medicare premiums. So we talked about the Secure Act, spending down an inherited IRA over 10 years, which makes you take out more each year, pay more taxes. There's something called IRMAA brackets, income-related monthly adjustment amounts, and it is a surcharge on your Medicare premiums if you make too much money. So if you can convert your qualified dollars before the age, not 73 now we're not talking RMDs, now we're talking pre-age 65, you can get yourself out of another one of those government traps to make you pay more for something just because you've got a lot of money sitting in a qualified account. If you got $2 million sitting in a qualified account, you are almost certainly going to find yourself paying more for Medicare than you need to. And if you're pre-65, you haven't signed on for Medicare yet, you've still got time to avoid that pseudo tax increase where you're paying more for Medicare than most people just because you've done a great job saving for retirement. And it doesn't have to be that way. And guess what? That's you paying taxes. That's what that is.
I've got an example of this. I had a client come in, it's been a while, and we were having a conversation about retirement income. And of course, Social Security is the biggest one. And they had done a great job saving, had a lot of money in their 401k, which we rolled over to an IRA, and all seemed to be well until we got to the point where we were deciding or looking at what their Social Security was actually going to be. How much monthly income are you going to get from Social Security? Well, what this client didn't know when they came in was the amount of money they had qualified and their RMDs that were going to be coming in the future was going to put them into this exact situation that Matt just talked about.
The IRMAA brackets.
They're going to be in an IRMAA bracket, which means they're right in the crosshairs of the government's favorite folks to tax. What it all boiled down to was if they didn't make changes while they had time to, their Social Security check was going to be $0 every month. Now, how can that be? They earned a lot as they were working. They put Social Security away. They paid FICA taxes for a long, long time. How could their Social Security check be zero? Well, it's because their Medicare premium, as Matt just described, comes out of their Social Security check, and they're in this IRMAA bracket, which means that they're penalized essentially for the amount of money they've got qualified, to the point where their Social Security check was basically zeroed out. It was nothing, only because they had to pay for their Medicare premiums, and the IRMAA bracket basically canceled out their entire Social Security. Now, what they didn't know was they had time. They could make changes. They had until age 73 before RMDs kick in. They had time before they filed for Social Security, I should say, or Medicare at 65. They had options. They didn't know they had options. If they didn't act, if they wouldn't have acted, they literally would have missed out on a monthly Social Security check. All because of what? Because the government increased tax brackets. No. That's not what happened. They didn't increase tax brackets. It's this lovely thing called the IRMAA brackets that Matt's talking about. There are plenty of landmines out there that if you just know what they are. We're not talking about some really expensive ways to write trusts and do these things to find some loopholes and play the shell game. We're not talking about that. All we're talking about is knowing the rules of taxation and knowing how all those affect your retirement accounts, and knowing it and planning for it and executing a plan in enough time to get that money over the fence. It can make a world of difference.
So when we talk about IRMAA brackets and we talk about required minimum distributions, I think, and Mark, you asked about tax-free dollars. Mm-hmm. It's important to understand that there's only a few types of income that don't count towards these really large IRMAA bracket surcharges for your Medicare premiums. And that would be income that comes from Roth accounts, municipal bonds, and then the other thing would be if you take money out of a life insurance contract.
Yeah, cash value in your life insurance contracts.
Those are the only three sources of income. Now, obviously, if you have cash, that's not taxed. But in terms of something that's going to grow, those are the only three sources of income that don't get factored into these IRMAA brackets that aren't going to create tax increases in the future. And so that's why we're big on, let's get ahead of this. If we can do it before 73, great, because maybe we can avoid RMDs. If we can do it before 65, even better, because now we can also get you out of falling into an IRMAA surcharge on your Medicare premiums. And we're big on Roth conversions. Those have to happen. Well, those should happen before 73, because a Roth conversion after 73, like we talked about a couple weeks ago, that's actually not going to satisfy your RMD. So it doesn't actually do as much good if you wait too long. But if you get to it early, Roth conversions are huge. Part of our full-blown retirement plan, part of our retirement roadmap, we tell you how much you should convert to Roth every single year in order to avoid these things.
Is there an age where it's too early or too late? You just mentioned after 73, but can you start converting to Roth at 45?
You can
50?
start converting to Roth whenever you want. Now, you can't convert your 401k dollars to Roth dollars if you're still working there, right? So we're talking IRA money. We're talking money that's outside your employer-sponsored plan. You can convert that at any time. It just comes back to that mindset. Do you have the mindset of, I did make this handshake deal with the government. They are part owner in my retirement accounts, and I will take the spanking, not the grounding. If that's your mindset, well, then we can put a plan in place to get this over and get it over as quickly and as painlessly as possible. But there's still going to be a little bit of pain, because the reality is the government's a part owner in those accounts.
And look, I'm not all riled up here because I just hate taxes. I mean, look, I don't have any problem paying my fair share of taxes.
Sure.
I like nice roads. I like having a good, strong police force, just in case. I like having a fire department in case my house catches on fire. These are all funded by taxes. So I'm okay paying my fair share, but it's this like smoke and mirrors, this secretive stuff behind the scenes that really bugs me. That's what gets me fired up.
770-741-0120. Again, 770-741-0120. Spanking, not the grounding. I want somebody who just flipped the radio on, checking out Retire ATL this morning, and they're going, wait, what? I can either get spanked or grounded? No. This is all part of the tax strategy that the team at the Vincent Financial Group, they want to customize for you. 770-741-0120. RetireATLradio.com for more information and how to take advantage of that retirement roadmap. We got a couple of minutes left here. Before we get out of here, I want to talk about tax buckets.
Yeah.
So talk to me about tax buckets, deferred, taxable, tax-free. What's most important?
Well, there's really three types of dollars when it comes to the tax reality. You have tax deferred dollars. That's money that goes in. You don't pay taxes from year to year. You pay taxes when you take the dollars out. It's tax deferred.
You defer the taxes till later.
Defer the taxes. 401k, 403b, SEP, Simple, TSP. All those accounts, tax deferred accounts. Then you have taxable accounts. That's going to be your brokerage accounts. So you're getting 1099s on those accounts every single year for the growth. Those are taxable accounts, and most of our clients have taxable accounts.
You're paying taxes every year. When you file your taxes, whatever growth or gains you have, you pay tax on that. It's not deferred till later. Taxable this year.
It could be long-term capital gains. It could be short-term capital gains, but that's how that's calculated. And then the third category is tax-free dollars. The only thing that fits really in tax-free dollars would be Roth accounts, whether it's a Roth 401k, Roth IRA. You've got municipal bonds. Those are tax-free. If you sell the bond, it's not tax-free, but the income from a municipal bond, tax-free. And then the third thing would be if you have life insurance contracts that have a cash value component, if you do it right, you can actually structure those to generate some non-reportable dollars for whatever you need to use it for. But the IRS does not consider those distributions taxable. Again, you got to do it right. But life insurance can be a source of tax-free dollars. Those are the only three tax-free buckets or tax-free vehicles that are out there. And those are the three buckets: tax-deferred, taxable, and tax-free. And what's really cool is there's actually a mathematically right amount for you to have in each of those three buckets. Now, my number is not the same as Aaron's number, is not the same as Mark's number. But for you and your retirement goals and your lifetime tax that you're going to pay throughout retirement, there's a mathematically correct amount of dollars to have in each of those buckets. If you wait until 73, we're probably not going to be able to get it as good as we could if we did it pre-73. And if we can get to you before 65, we're probably going to make it even better, because then we can also avoid those IRMAA surcharges that we were talking about. But there's a mathematically right amount to have in each of those three buckets.
Now more than ever, the importance of having a tax strategy with the help of the team of the Vincent Financial Group. 770-741-0120. Again, 770-741-0120. Aaron Vincent, we scheduled that initial consultation. It's no cost. It's no obligation, either via Zoom or we come to the home office in downtown Woodstock. What can we expect in that first meeting with you and the team?
What you can expect, first of all, is for us to want to get to know you better. Look, everyone is different. And so we want to know, what are your expectations? What are your hopes? What are your dreams? What are your goals? And then from there, we want to begin to gather enough information to help build a plan for you. But it just happens initially from us getting to know you better. Don't bring your wallet. Don't bring your checkbook. We're not going to ask you for anything from a cost perspective. We want to understand, are you someone who, number one, wants our help? Is this something, are these questions that you have? Are you interested in solving these problems? And number two is simply, can we help you? You have certain goals, you have certain dreams, you have certain expectations. Are we a good fit to help you? That first conversation is simply figuring that out.
Now, the main office in Woodstock, but you also do a lot via Zoom as well, Aaron. So if that's more comfortable, don't want to get in the Atlanta traffic, always available via Zoom.
I would say most folks for that initial conversation prefer Zoom.
Yeah.
It's easier. It's more convenient. You want to get to know us better. We want to get to know you better. Often that first conversation is via Zoom, but hey, if you want to come to our office, we'd love to show you around.
Exactly. I love how he said that too. Just leave your checkbook, leave your wallet. You're not going to need it. That initial conversation, opportunity just to get to know each other. 770-741-0120. Again, 770-741-0120. Ask for that retirement roadmap. It's no cost, no obligation from the team at the Vincent Financial Group. Well, Aaron, Matt, thank you. Thank you for the education and the information this weekend. RetireATLRadio.com to get more information, and we invite you to check out the Retire ATL Radio podcast. It is available across all podcast platforms. We're back next weekend, but for Aaron Vincent and Matthew Decker, this has been Retire ATL right here on WSB.